We have James Henry. He's a senior managing director and co-founder of the Bank Street Group, a placement agent for financing. James, thank you very much for joining us at DatacenterDynamics New York.
Thank you. Very happy to be here.
James, how much debt and private equity is available for data center construction in the U.S. today as compared to pre-recession levels? And what developments in this area should we expect in the future?
Well, it's been an incredible rebound for the sector. Anecdotally, if you look at 2010, $8.5 billion of debt was raised by data center companies. You compare that to 2009, it was less than $2 billion. So more than a four-fold increase in the span of a year, which I think is good evidence that the market has rebounded. Now, to be clear, a lot of that money raised has been refinancing existing debt or for acquisitions. CyrusOne, for example, getting acquired by Cincinnati Bell. But clearly a large chunk of that is for organic growth and investment into new data centers or expansion of new capacity. I would say the biggest trend has been with some of the new entrants coming in, folks like Stream Realty, for example, or Vantage Data Centers, which is a portfolio company of Silver Lake Quality Technology Services. These are entities buying massive facilities, brownfield or legacy data centers, retrofitting them, bringing them current, and bringing on larger chunks of capacity in key markets across the country. So clearly there is robust capital availability for the right projects.
What attributes make a data center build successful in securing capital today?
Well, we're still very much in an environment where both equity investors and lenders want proof of concept in a business model. So we're not in the realm of if we build it, they will come, where you have speculative construction of capacity. And of course, that's something that tends to be fairly dangerous for the industry. I think the companies and the assets that tend to be most attractive to investors and lenders are larger scale platforms, companies with multiple facilities in multiple geographic locations. So you have diversification both on the risk mitigation side. You're not exposed to any particular market if you have a geological event or economic downturn. And at the same time, you also have greater diversity of opportunity, upside, and growth potential. So scale measured by size of footprint is important. Larger facilities tend to be more attractive. When you're kind of sub 25,000 square feet of space, it's hard to have a cost-effective operation managing a 24 by 7 by 365 facility. On the flip side, the staff that you would need for a 100,000 square foot facility is probably not much bigger than you need for 25. So there's a lot of operating leverage in larger facilities, and therefore that tends to be attractive to capital sources. I would say last but certainly not least, cash flow. There are some folks who are willing to invest in greenfield builds for anchor tenants or even additional facilities for existing cash flow positive companies. But by and large, lenders want the comfort of cash flow to make sure that they're betting on something that has proof of concept and a real customer base, not something that may get filled up someday.
How should data center operators or builders think about sourcing outside capital? What are the differences between debt and equity, and what's the relationship there?
So equity tends to be the first layer of capital, the risk capital that comes in when a business is getting started, and expects to be compensated fairly for taking that risk. And you see a lot of venture capital and smaller scale private equity investors jumping on board very early on in the company's life cycle and funding it to, say, proof of concept. Lenders tend to come in at a point where there's stabilized cash flow available to leverage, and they'll lend 3, 4, sometimes 5 times against an existing cash flow or EBITDA stream. There's always a delicate balance between debt and equity. Founders, owners, entrepreneurs, they tend to want to take more debt and avoid equity dilution, avoid sharing their ownership with other parties. But at the same time, they know that sometimes it's necessary to take on that capital to bring in additional capacity for growth. The other thing to point out is that equity while it was previously more focused on founding and starting companies, equity investors, predominantly private equity investors, have been most active in this cycle as acquirers of existing stabilized cash flow platforms. So you take Oak Hill acquiring ViaWest, or Welsh Carson acquiring Peak 10, going in, buying that, what appear to be fairly full prices, but then investing additional equity capital to drive future growth. So there's always a push-pull between the two, but we think both are vital to the successful capitalization of a good business.
How does the capital markets community look at cloud computing space today?
Cloud is a term on the tip of everybody's tongues. Unfortunately, it means different things to different people. To some people, the cloud is anything that's not hosted in your server closet down the hall. It's out there somewhere. To others, it is the way Amazon Web Services or Go Grid will think about it. It's clusters of high-capacity servers interconnected with one another across multiple sites, delivering massive amounts of computing power, storage, and bandwidth on a turnkey basis. And I think it's that latter element that really has a transformative element on the industry. And I think people are wondering, how will the cloud affect the status quo? Is that good or bad for existing data center operators? Is it good or bad for the dedicated server companies that seem to be right in the sweet spot of that same market? I think it's early days today, and investors have only precious few opportunities to play. Public investors look at Amazon's Web Services division as a very small piece of that company. Salesforce.com has Force.com, their cloud platform. So public investors look at that. They certainly look at Rackspace, which has a good and growing cloud business. But mostly the cloud has been the domain of Silicon Valley, venture capital and private equity, looking at the software platforms as well as new cloud service companies.
James, thank you very much.
Thank you.